Budget realism begins with disciplined estimation and structured contingency. Too many budgets assume best-case efficiency rather than probable performance. Realistic budgets incorporate uncertainty, accounting for errors, rework, inflation, and schedule drift. Contingency is not padding, it is protection, calibrated to risk maturity and project complexity. Layered contingencies separate general reserves from task-specific allowances, maintaining transparency while preserving flexibility. When leaders view contingency as weakness, teams hide variance. When they treat it as foresight, teams manage honestly. Realism in budgeting sets the tone for integrity in every subsequent financial decision. Understanding cost drivers grounds that realism. Labor, materials, and logistics dominate most budgets, and each carries distinct volatility. Labor costs shift with skill shortages, overtime, or regulatory changes. Material prices respond to commodity markets and supplier disruptions. Logistics costs swing with fuel prices and geopolitical conditions. Mapping these drivers and their sensitivities allows early warning when assumptions drift. Cost risk registers should track these elements explicitly, not as lump sums but as dynamic levers. When drivers are known, mitigation becomes possible through sourcing strategy, productivity improvement, or schedule adjustment before budget erosion occurs. Price volatility has become a defining feature of global markets. Linking contract prices to reliable indices, such as commodity benchmarks or inflation measures, transfers some risk away from guesswork. Indexation allows fair adjustment for both buyer and seller when conditions shift dramatically. For example, a steel index clause stabilizes cost negotiations amid unpredictable supply chains. However, index linkages must be chosen wisely. Not all markets move with equal transparency. Over-indexation adds complexity, while under-indexation leaves exposure unbalanced. The goal is proportionate flexibility, shared adjustment without abandoning discipline or accountability. Currency exposure introduces another layer of uncertainty. Multinational projects face exchange rate risk whenever transactions cross borders. Fluctuations can inflate costs or shrink margins overnight. Organizations can manage this exposure through hedging instruments such as forward contracts, options, or natural hedges created by matching revenue and expense currencies. The choice depends on volatility, duration, and cost of protection. Currency risk management is not speculation, it is insulation. Properly hedged projects maintain predictability even as global currencies move unpredictably, ensuring that progress depends on performance, not the day's exchange rate. Contract clauses provide a legal framework for handling currency movements. Currency adjustment provisions, payment currency specification, and rate review triggers clarify expectations before volatility strikes. Clauses may set fixed exchange rates for certain milestones or define formulas for adjustment when thresholds are breached. These mechanisms reduce dispute risk and ensure that financial exposure is transparent to both sides. A well-drafted contract turns uncertainty into procedure, transforming potential conflict into orderly recalculation. Legal foresight here prevents financial strain later, ensuring that fairness remains embedded in the commercial foundation of the project. Tax, duty, and compliance risks can quietly erode financial models. Import tariffs, value-added taxes, or local withholding requirements often shift faster than contracts can adapt. Failure to anticipate these obligations results in unplanned cost spikes or regulatory penalties. Engaging tax advisors early and building flexibility into budgets mitigates this threat. Projects operating across jurisdictions should maintain a tax compliance matrix, tracking applicable rates, exemptions, and documentation needs. This discipline transforms fiscal compliance from a last-minute scramble into structured assurance. Awareness of these subtleties protects profitability as much as headline costs or schedules. Financing risk arises from timing mismatches between expenditure and cash inflow. Even profitable projects can struggle when costs precede receipts. Cash flow forecasting, therefore, becomes as important as cost control. Payment milestones, loan draw schedules, and reimbursement cycles must align. Delays in one area cascade into liquidity pressure elsewhere. Contingency liquidity reserves and early warning metrics, such as days cash on hand, guard against this strain. Financing risk reminds every project manager that solvency is rhythm. Success depends not just on earning money, but on earning it in time to meet obligations without disruption. Payment terms and counterparty creditworthiness define another layer of financial exposure. Lenient terms to unreliable clients or suppliers turn goodwill into cash flow risk. Credit assessment, escrow mechanisms, and milestone-based payments align incentives and limit exposure. Retention clauses can protect against incomplete delivery, while performance bonds secure compensation if obligations fail. Counterparty monitoring should continue throughout the project, as financial health can change quickly under market pressure. Managing who pays and who performs with equal rigor transforms financial governance from routine paperwork into operational defense. Inflation scenarios must be incorporated into planning, not merely acknowledged as background noise. Sustained inflation compounds through wages, materials, and financing costs. Escalation models help quantify potential impact under various conditions, guiding decisions about reserves or early purchasing. Scenario analysis transforms inflation from surprise into range-based forecast. By simulating different trajectories, stable, moderate, or high inflation, teams can see which activities are most vulnerable and adjust accordingly. Inflation awareness keeps optimism anchored to realism, ensuring that financial confidence is earned through modeling, not hope. Affordability thresholds translate complex forecasts into clear go or no-go guidance. Each project should define its maximum viable cost or exposure level beyond which continuation endangers viability. These thresholds help leadership make rational decisions when budgets tighten or forecasts deteriorate. They remove emotion from debate, replacing "can we keep going" with "does it still meet the defined condition for success?" Affordability criteria enforce discipline in the face of sunk cost bias. They remind teams that courage sometimes means stopping when the economics no longer justify continuation. Continuous monitoring of financial indicators sustains awareness long after approval. Budgets drift subtly without visible triggers unless tracked actively. Key indicators, cost variance, earned value, margin trend, and working capital must be reviewed at defined cadence. Linking these metrics to risk thresholds enables automatic escalation when variance exceeds acceptable limits. Monitoring transforms financial control from quarterly reaction to real-time management. It is through this vigilance that projects maintain course correction capability, preventing small deviations from snowballing into crises that threaten delivery or profitability. Communication turns numbers into understanding. Translating complex financial trade-offs into plain language bridges experts and decision-makers. Charts and jargon mean little without context. What does the variance imply for schedule, staffing, or capability? Financial clarity builds credibility. Leaders who communicate trade-offs in simple terms, cost today versus savings tomorrow, help others make grounded decisions. This transparency nurtures trust between finance teams, engineers, and sponsors, ensuring that everyone speaks the same pragmatic language of risk, value, and return. Clarity in money matters prevents surprises more effectively than spreadsheets ever could. Financial discipline is the foundation of stability. It cushions against shocks and preserves freedom of choice. Projects grounded in sound estimation, hedged exposure, and transparent reporting navigate uncertainty with composure. Discipline does not eliminate risk, it transforms it from chaos into control. When costs are known, currencies managed, and contingencies respected, feasibility becomes resilience. In the end, financial risk management is less about prediction than preparation, ensuring that the organization stays solvent, credible, and confident whatever the markets decide to do next. Thanks for listening. For more audio courses, daily newsletters, and more, please visit DailyCyber.News.